The compression cycle continues. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:04 a.m. Central Time, and I'm recording this in preparation for the market day of April the 9th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see what happened in our overnight action. Well, just a little bit of weakness at the time of this cut, and really nothing that the open couldn't just run right over. This really is non-significant across all four of the broad market indices. What is significant is crude oil. Crude oil up about 2%, so big move in crude oil already. With the euro, you're down about 0.3. Bonds are about scratch, and gold is down also about 0.3. In terms of the overseas action, you have China, looks to be down about 1%. Remember, China had about a 4 standard deviation up move yesterday, so big move there. In fact, if you look at some ranking reports, you'll find China-related ETFs may even be like 9 out of 10 the top 10 ETFs going right now, and that was prior to yesterday's action. So China definitely worth taking a look at. Hong Kong up about 2.7%, up very large. Japan up 0.75, also an ETF worth looking at. Germany up about 0.43. Germany's another ETF that is probably doing very, very well. And it's worth looking at some of these individual segments as opposed to simply looking at EEM or EFA, which has a lot of junk weighing them down. So anyhow, just a quick little comment there. In terms of macroeconomic reports, of course, it's Thursday, so you have all the typical unemployment claims, natural gas, 30-year bond auction occurs today. So if you're a bond trader, you need to be aware of that. That is sitting out there. And in terms of tomorrow, import prices looks to be about it. Well, you have federal budget balance in the afternoon, but that's a yellow flag report, so not too much to get worried about. In terms of our current volatility measures, we continue to just be really, really low, and especially after FOMC minutes were released yesterday, it was a giant yawn by the market, and this is really quite complacent. Notice that the short-term VIX is now below 13. We are still in a daily squeeze on the VIX, so you know, obviously we're going to look for this volatility to increase at some point, but it has not done so yet. Standard deviation moves, while we had so much activity for about 2 weeks there, has clearly ebbed off, and really we're now you know, starting our 5th trading day with low activity. We'll see if that continues through the day today, and we have a whole week of low volatility. In terms of our regular daily report, not a lot of changes here. Again, we continue to be elevated risk levels. Phase 3 opinion still stands. Higher highs and higher lows is still the big call. And until we get a violation of the pattern, well, that's where we're going to look for. But we do have very much flies in the ointment. Portfolio investor posture, IBD status remains uptrend under pressure. We still are sitting at only, I believe, 13 trading days in this entire year in which we have had a clean uptrend that was obvious, with hedge risk levels at a 0. Very, very little kind of clean bull action for this far this year, and we certainly remain in this IBD status with an uptrend under pressure. GMI still also a 3 out of 6. Active trader market posture is back to bullish, and we'll talk about that more in just a second. Investor position sizing opinion remains at up to 50%. Active traders with the VIX as our metric, we're still within the window, so that does call for a larger position size. So a little bit of a conflict there and disagreement. Market timing opinions remain neutral, both the 1-day, 3-day, slightly bearish for the 2-week. But notice here, market posture, first day bullish, and indeed all four of the broad markets bounced back to bullish after just going, we were bullish, and then after literally like 1 or 2 days bullish, went to bearish on the market posture, and then now right back to bullish. And what that really should be telling you is that it's neutral. And while the technical stance of these indicators is calling for bullish, I would tell you to read this as neutral, and really all this to read as a very, very neutral market under compression. And you should be trading this as traders, not swing, looking for big targets and these kinds of things. If you are taking swing trades within the ranges, you need to take quick profits and seek to protect quickly as well, because this action is very, very poor action for significant follow-through. Hedge risk level continues to be level 2. You see from the various factors that input to this, still a number of warning signs. The VIX squeeze, the distribution count. This has come down a couple notches. On the NASDAQ, we're down to 7 now, but still at 8. These are still very elevated levels. Anything over 4, really, we take note of that. We still call the VIX phase neutral because it keeps flip-flopping back and forth, though it's currently at a relatively low level. New highs, new lows was, pretty sound yesterday with 306 new highs versus the new lows at 58. We still have that crash warning sitting out there, and we still have 4 of the 5 risk aversion indicators, flagging as risk-off conditions. No changes in these 3 primary opinions for today, so I won't spend a lot of time on this, but bottom line is, while the VIX is within the acceptable window, given the number of standard deviation days that we've had, which is starting to ebb off, you might want to consider reduced position size. Cover call, certainly a pretty conservative stance on initiating positions at this point, given the hedge risk level. If you are in positions, manage them. And then, of course, a 2-for-1 distribution between in the money and out of the money, especially if you're rolling and you need to roll a covered call, something you want to keep, you might want to consider this opinion. Put selling, again, still this caution to be exercised in establishing new positions until this bottoming pattern forms. So not a lot of changes for today, as I said. And really, as long as we stay in this compression, there's not going to be probably as many changes as what we might see in a more normal market condition. Sector market posture, again, these flat lines, kind of don't give the strongest of signals. It looked like a lot better yesterday. We got a lot more neutral stance here, certainly a lot more green. Only transportation still, outright negative, but that's not a good sign. I mean, we want transportation to be very bullish and to be in lockstep with the S&P broad market. And when transportation is flagging, that is certainly a warning sign. In terms of the returns for yesterday, you notice, obviously a broader bullish day across most of the sectors, with the exception being energy, obviously, telecommunications and utilities. So utilities and energy continue to be something of a story where they both seem to be seeking a bottom, but continue to exhibit significant volatility. Industry level, we have retail, internet, healthcare, railroads, and biotech as some of the leading industry groups that you might want to take a look at. So that should be enough for today. As always, greatly appreciate what you're doing and your own contributions to the trading community, and certainly investing in us by liking us on YouTube. If you have additional questions, please go to the website, falconglobaltraders.com, and support at falconglobaltraders.com for email. Disclaimers as always, hit the pause button so that you have more time to read this at your pace. And then we'll look forward to seeing you back here tomorrow just before the market opens once again. Thank you.